Jay Gould's family background and early life were rooted in the rural world of upstate New York, far removed from the financial empires he would later command. He was born on May 27, 1836, in Roxbury, a small farming village in Delaware County in the Catskill Mountains. Gould grew up in a modest household. His father, John Burr Gould, was a farmer and sometimes worked in small-scale business pursuits, while his mother, Mary Moore Gould, came from a local family with similarly humble means. The Goulds were not wealthy or socially prominent. Their life reflected the hard work and self-reliance typical of rural New York in the early 19th century. Gould's upbringing in Roxbury was shaped by this environment. As a boy, he worked on the family farm and became familiar with manual labor, discipline, and frugality. At the same time, he showed an early aptitude for study and numbers. Unlike many children in the area, he received more than basic schooling, attending local schools and later Hobart Academy, where he developed strong skills in mathematics. This education helped him find work as a surveyor while still a teenager, giving him early exposure to land values, contracts, and speculation. The contrast between Roxbury's quiet agricultural life and Gould's later reputation as a ruthless financier is striking, yet his early years there, marked by limited resources, practical labor, and an emphasis on self-advancement, played a key role in shaping his relentless drive, careful calculation, and willingness to seize opportunity wherever he found it. While still in his teens, he moved beyond farm labor and began working as a surveyor and civil engineer, a profession that placed him at the crossroads of land, contracts, and speculation. Surveying taught G. Gould how value could be created or manipulated on paper before it ever existed on the ground. He learned that land boundaries, routes, and future development mattered as much as physical property itself. By his early 20s, Gould had partnered in a small tannery business in Pennsylvania. This was his first real commercial venture, and it exposed him to bookkeeping, pricing, supply chains, and competitive markets. Unlike many young businessmen of the era, Gould focused obsessively on efficiency and leverage, carefully analyzing costs and returns rather than relying on custom or goodwill. The tannery venture also delivered Gould his first major lesson in risk. He expanded aggressively, borrowing money and speculating on future demand for leather. When market conditions shifted, the business faltered. Rather than being ruined by the failure, Gould emerged with a sharper understanding of timing, leverage, and the danger of overextension. This experience hardened him. He learned that sentiment and trust were fragile, markets were unforgiving, and survival often depended on acting decisively, sometimes ruthlessly, before others could react. From this point forward, Gould became far more cautious in public and far more calculating in private. By the time Gould entered larger financial markets, his personality was already well formed. He was intensely ambitious, determined to rise far beyond his rural origins. Unlike flamboyant contemporaries, Gould was quiet, secretive, and emotionally controlled. He preferred strategy over spectacle and calculation over charisma. Gould developed a reputation for cunning rather than charm. He believed markets were battlegrounds, not social institutions, and saw little moral obligation to competitors or the public. This mindset, shaped by early hardship and business setbacks, would later earn him notoriety, but it also made him exceptionally effective in high-stakes financial warfare. Railroads were the dominant economic force of the mid-19th century, and Gould recognized their potential earlier than most. He began with small railroad investments and stock speculation, often targeting undervalued or poorly managed lines. Rather than focusing on long-term operation, Gould concentrated on control, stock structure, and inside leverage. He mastered techniques such as stock watering, strategic buying and selling, and influencing corporate governance. These early railroad maneuvers were modest in scale, but critical in refining the tactics he would later use on a national level. Each deal sharpened his understanding of how transportation, finance, and politics intersected. By the time Jay Gould emerged as a major figure on Wall Street, the foundation of his empire was already firmly in place. His rural upbringing instilled discipline and self-reliance. His early business failures taught him caution and adaptability. And his initial railroad speculations provided a laboratory for mastering financial manipulation. Gould did not rise suddenly, he evolved. Every early experience, from surveying Catskill farmland to navigating minor railroad boards, contributed to a worldview in which information, timing, and control mattered more than reputation or public approval. These lessons would later allow him to dominate vast railroad systems and become one of the most powerful and controversial financiers in American history. In the decades following the Civil War, the United States experienced a dramatic expansion of its railroad network, driven by industrial growth, westward settlement, and federal support. Railroads became the backbone of the national economy, linking agricultural regions, industrial centers, and ports. Government subsidies, including land grants and favorable legislation, encouraged rapid construction, often without adequate regulation. This environment created immense opportunities for financiers. Railroads required vast amounts of capital and were frequently overextended, mismanaged, or deeply in debt. As a result, control of railroads often depended less on engineering expertise and more on financial maneuvering. Jay Gould entered the railroad industry at a time when ownership and power were fluid, allowing skilled speculators to acquire influence without owning large physical assets outright. Gould's rise to prominence began with his involvement in the Erie Railroad, one of the most chaotic and corrupt railroads of the era. Through alliances with figures such as Daniel Drew and Jim Fisk, Gould gained control by manipulating stock issuance and corporate governance. Although the Erie Railroad was poorly managed, it provided Gould with invaluable experience in large-scale railroad finance and public battles for control. Later, Gould expanded westward by acquiring the Missouri Pacific Railroad, which became the cornerstone of his empire. Unlike Erie, Missouri Pacific offered long-term strategic value by connecting Midwestern and Southern markets. Gould also gained control of Western Union, recognizing that communication networks were as critical as transportation. By controlling both rail and telegraph systems, Gould integrated infrastructure in a way that magnified his economic power. Gould was a master of stock manipulation, operating in a financial system with minimal oversight. He used practices such as stock watering, issuing shares beyond the company's actual value, cornering markets, and spreading misinformation to influence stock prices. These methods allowed him to seize control of companies without majority ownership, often forcing rivals to sell at inflated or ruinous prices. Hostile takeovers during this period were not only legal but common among aggressive financiers. Gould's ability to exploit complex financial instruments and insider knowledge gave him a decisive advantage. While critics condemned his actions as unethical, they were largely permitted under contemporary corporate law, reflecting the broader instability of Gilded Age capitalism. The Gold Heist, Black Friday, 1869. While the world saw Jay Gould as a railroad king, his most dangerous play wasn't in steel, it was in gold. In 1869, Gould realized that if he could corner the gold market, he could control the pulse of the American economy. He didn't just play the market, he rigged it from the inside. Gould used mafia tactics to infiltrate the White House, bribing President Ulysses S. Grant's brother-in-law to ensure the government wouldn't sell its gold reserves. With the president effectively sidelined, Gould and his partner Jim Fisk began buying every ounce of gold in New York. The price exploded, and Wall Street descended into a feverish panic. But Gould was a shark who ate his own. When he sensed the government was about to intervene, he secretly sold his holdings while publicly encouraging his friends to keep buying. On September 24th, the original Black Friday, the Treasury finally dumped its gold. The market collapsed instantly, ruining thousands of families and triggering a national depression. Gould walked away with millions in profit, leaving the country in ruins and earning his title as the most hated man in America. Success in the railroad industry required political as well as financial skill. Gould cultivated relationships with judges, legislators, and local officials, using campaign donations, legal maneuvering, and influence to protect his interests. Courts were often sympathetic to corporate power, and injunctions could be bought or delayed through strategic litigation. Legal loopholes, particularly in corporate charters and state regulations, allowed Gould to restructure companies in ways that favored insiders. The lack of federal regulation prior to the Interstate Commerce Act of 1887 meant that railroads operated with little accountability. Gould's ability to navigate and exploit this legal landscape was essential to maintaining control over his expanding empire. Rather than seeking national dominance, Gould focused on regional control, especially in the Midwest and Southwest. By owning multiple rail lines within the same regions, he could dictate freight rates, suppress competition, and influence local economies. Farmers, merchants, and towns became dependent on Gould-controlled railroads for access to markets. This concentration of power allowed Gould to shape economic development across entire regions. His decisions affected land values, industrial growth, and settlement patterns. While this strategy increased efficiency from a corporate standpoint, it also deepened public resentment, reinforcing perceptions of Gould as a monopolist who placed profit above public welfare. Gould operated in a fiercely competitive environment dominated by powerful rivals such as Cornelius Vanderbilt. Unlike Vanderbilt, who emphasized operational control and consolidation, Gould relied more heavily on financial strategy and indirect control. Their clashes, particularly over the Erie Railroad, illustrated two competing models of capitalism: industrial management versus speculative finance. Gould's methods of competition included rate wars, secret alliances, and strategic bankruptcies. He often allowed companies to fail financially if it meant retaining personal control or eliminating rivals. These tactics earned him widespread criticism, but also demonstrated his willingness to sacrifice short-term stability for long-term dominance. The Erie War was a dramatic financial battle in the late 1860s between railroad tycoon Cornelius Vanderbilt and speculator Jay Gould for control of the Erie Railroad. Vanderbilt tried to buy up Erie stock to gain ownership, but Gould and his allies fought back by secretly issuing new shares, diluting Vanderbilt's holdings. Courts, politicians, and even judges were drawn into the conflict through bribery and legal maneuvering. The struggle exposed the chaos of unregulated capitalism in the Gilded Age and marked Gould's emergence as a master of financial warfare. Jay Gould, working with James Fisk, attempted to corner the U.S. gold market in 1869 by quietly buying gold and using political influence to prevent government sales. Their goal was to force prices upward for massive profit. When the U.S. Treasury intervened and released gold, the scheme collapsed, triggering Black Friday. Gold prices crashed, harming banks, farmers, and ordinary citizens who depended on stable markets. Newspapers and the public condemned Gould as a symbol of greed and corruption. The episode revealed the dangers of unregulated finance in the Gilded Age. After surviving repeated financial battles, Jay Gould shifted from aggressive takeovers to consolidation and long-term control. He expanded heavily into Western railroads, linking regional lines into powerful networks that dominated transportation across the Midwest and Southwest. Through mergers and vertical integration, Gould connected railroads with telegraph lines, banks, and related industries, tightening his grip on infrastructure and capital. His influence extended into banking and politics, where strategic alliances helped protect his holdings from regulation and rivals. Publicly, Gould was viewed as a ruthless robber baron, while privately, he operated cautiously and methodically. These strategies ultimately made him one of the richest men in the United States. Jay Gould's career was marked by constant controversy, making him one of the most criticized figures of the Gilded Age. The Erie War and the Black Friday gold scandal revealed his reliance on stock manipulation, political influence, and legal loopholes to gain and protect power. While these tactics were often legal, they exposed the weaknesses of an unregulated financial system and caused widespread economic harm. The press portrayed Gould as a ruthless robber baron, blaming him for market instability and public suffering. Political cartoons and newspapers depicted him as a symbol of greed and corruption. Despite repeated investigations, Gould avoided serious legal consequences by exploiting favorable laws and courts. Historians remain divided over his legacy. Some view him as a financial genius who mastered modern capitalism. Others emphasize the damage his methods inflicted on the economy. Together, Gould's scandals and survival shaped public attitudes toward wealth, regulation, and power, helping define the era of Gilded Age billionaires. Jay Gould died in 1892, leaving a vast fortune and a lasting impact on American business. Through railroads, telegraphs, and strategic mergers, he shaped markets, pioneered corporate consolidation, and set a model for later monopolists and robber barons. His ruthless tactics exposed weaknesses in unregulated finance, inspiring reforms like the Interstate Commerce Act. While controversial, Gould's strategies transformed infrastructure, regional economies, and the stock market, demonstrating both the power and danger of concentrated capital. His legacy connects the Gilded Age to modern finance, showing how ambition, risk, and innovation continue to shape the U.S. economy.